Aloha, I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants, and author of the books on the tax-free cash growth warehouse strategy. In this video, I'll be talking about how we use annuities in conjunction with the infinite banking TFCGW strategy. Now, the whole point of infinite banking and the tax-free cash growth warehouse strategy is to save and grow our money as we continue to put it to use by leveraging it and taking advantage of certain beneficial options such as interest rate arbitrage. Now, most of us have some limits on how much money we have available and what we can count on to be available into the future. And there are limits to how much cash value we can load into our accounts without losing the tax advantages. With those points in mind, certain types of annuities can play an important and valuable part, especially in setting up an infinite banking TFCGW account. And here's what I mean. This is an actual example and a fairly common one at that. A client has money sitting in a retirement account that is tied to the stock market. They've experienced the losses of their savings in those accounts due to the volatility of the markets in the last several years. And they want to protect what's left and get their money into an account that they can use for growth and financial flexibility. Enter the tax-free cash growth warehouse account. Might as well make this interesting. So I'll use the example where the client has two retirement accounts. One is a qualified account, a 401k. That means the interest and the gains. In fact, all of that money is tax deferred. And the other is a non-qualified IRA. The client has $200,000 in the 401k and another $200,000 in the IRA. Well, we want to get all $400,000 into the new infinite banking TFCGW account, but we can't do that all at once because that would require a really huge policy and the premiums would continue to be quite large. So taking into account the fixed income of the client and the desire to get all that money into the new TFCGW account without making the account a MEC and losing the tax advantages, we're going to use a special annuity. And here's how that works. I designed a 10-pay infinite banking TFCGW account for the client. That means premiums will be only paid into the account for 10 years. After that, if the client wants to feed more cash value into the account, they can, but it won't be required by the design of the policy. With the goal of getting that $400,000 into the account as quickly as possible, I designed an account that has a premium requirement of $30,000 per year for 10 years. That allowed for an additional $40,000 to be loaded up front without exceeding the MEC limit. So we established at the same time a 9-pay immediate annuity and put about $300,000 into it. Now, the money in the annuity will be growing at a guaranteed 2.5% APR, considerably better than in a bank savings. And the annuity will pay out the entire amount in the account over the next 9 years. This way, the client puts the first year premium plus an additional $40,000 into the new TFCGW account right away. The remaining $300,000 is growing in the annuity, and each of the next 9 years, the annuity will pay out the annual premium for the TFCGW account. Now, as I mentioned earlier, we used an interesting example here where half the money had been in a qualified plan that is tax deferred, and the other half in a non-qualified account, which is already tax money going into the account. So that means that income tax has to be paid, on the amount that was in the qualified plan. So in order to avoid having to pay all the tax on the $200,000 at once, we actually established two 9-pay annuities. One is a qualified annuity, and the other is a non-qualified annuity. So by rolling over all the $200,000 of tax deferred money into another qualified account, the client didn't have to pay any tax yet. It's still in a qualified account. Then, as each year a portion of that untaxed money is paid out to the client, which will be used to pay the annual premium on the TFCGW account, tax will need to be paid, but only on the portion that's coming out of the qualified annuity account. And using the TFCGW strategy, the tax on that $15,000 or so that's coming out of that annuity can be paid after it's deposited into the TFCGW account. Of course, that's done by taking a leveraged loan from the TFCGW account to pay the tax. And all that $15,000 gets added to the total cash value that's growing with dividend interest in the TFCGW account. But it's actually better than that. And because that $15,000 isn't the only money that's growing inside the TFCGW account. No, there's the original $70,000 that went in at the start of the account and another $15,000 going in from the other non-qualified account annuity, plus the interest that was already paid into the account. And all that dividend interest is compounding inside the account. Because of the way that particular account is set up and the front-loaded funds into the account, that client has actually seen about $30,000 in gains over what they've paid in just 4 years. And there's no tax on those gains. Pretty cool, huh? That is actually the most common use of annuities with infinite banking and the tax-free cash growth warehouse strategy. If you liked what you learned here, please subscribe to this channel. Also, please post your comments and questions in the comments area. And if you haven't yet, watch the free 60-minute webinar, How to Become Master of Your Financial World. Just click on the link in the description box below here. And if you'd like our help in getting your tax-free cash growth warehouse started, you can email or call us at the address and phone number also in the description box below here. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.